Hi, and welcome to our May market update, where we're going to take a little bit of a deep dive into what the market is doing. All right, so this is based on April, and we're going to be looking at month over month. April is compared to March, and then April is compared to April of last year. So these are the statistics that we're looking at. We're actually going to go to the next slide here because we have a little bit more of that historical data letting us look year over year. So where did we end up with as far as active listings at the end of April? We had 3,204 active listings on the last day of April. This is an increase of 44% and an increase of about 23% when we look at April of 2021. Now, two things to look at here. This is measured on the last day of the month, which for April, last day of the month was a Saturday. You have a lot more active listings on a Saturday than you do, say, a Tuesday or a Wednesday. So that can impact that number. And also year over year, we have to remember that 2021 wasn't a typical year in real estate. We had a lot of people that in 2020 either pulled their homes off of the market or delayed entering the market just because of the uncertainty that COVID brought. And so we saw a lot of those people enter the market in 2021, which kind of resulted in more homes on the market throughout 2021 as people felt more comfortable. The amount of closed homes was 4,912. That was a 3% increase over March, but again, down as compared to year over year. Both the average and the median close price increased month over month and year over year. Average close price saw us be at about 3.5% increase over March and 17% increase over March of 2021. Median close price saw us be at about a 4% increase over the prior month, and year over year, about a 19% increase. Now, keep in mind, these are for properties that went under contract in under contract in March and closed in April. Median days on the market was 8, and we see that this was a decrease for average days on market. Median days on market is about 4 days on market, and that has remained unchanged. I feel like that one's actually a little bit better metric for measuring where we are in the market. So we talked about that appreciation. What can we expect for the rest of 2022? Well, we saw our market pop a little bit earlier this year. The spring market really popped in February and March, and those appreciation numbers, we saw January was pretty flat. Median appreciation for February was about 6.5%. March median appreciation was about 5%. And again, for April, we hit almost 4% appreciation. So you can see that starting to slow a little bit. Couple of reasons for this are, the higher interest rates. We're seeing those mortgage rates go up. Again, that market kind of popped early, and some buyer fatigue. Buyers are just a little bit worn out with the pace of this market. I want to be clear that we're also talking about slowing appreciation. We're not talking about negative appreciation or property values decreasing. Let's talk about something that we're hearing mentioned more in the media and economists talk about, and that is the R word, recession. So what are recessions? What kind of impact or relationship does that have with housing values? When we look back, even as far as the 1960s, we can see these blue lines here are recessions. This white line here is the housing index. This is nationwide. And so we can see pretty flat there, maybe a tiny little dip after the 60s. We can see that with these recessions, housing prices have continued to increase, with the exception of the 2008 recession. And what do we know about that recession? Well, housing led that recession with the subprime mortgage meltdown. We can see that the wheels started to fall off the bus here in about 2005, 2006. And then here's our recession that hit in 2008. And it definitely took us a while to work through that. So we had a couple factors there. We had a lot of short sales. We had a lot of foreclosures that attributed to the decline in housing values. We also had builders that overbuilt for the market. The builders were supplying and building far more houses than there were buyers that were out there to be able to purchase them. So it definitely took us a while to work our way through that crunch there. And you can see even in this short recession that we had here, we've continued to experience that increase in housing prices. So let's talk about what are we expecting as far as foreclosure? Well, let's look at forbearances. That's a pretty good indicator. We can see here that of the people that have mortgages in this country, that 2.3% of them are the ones that are in some sort of forbearance. This is this data is current as of October 2021. So that's a pretty small number as far as all of the borrowers that are out there. And remember, only about 35% of homeowners don't even have a mortgage. Okay, so for that small amount, that 2.3% that are in forbearance, how many of those borrowers have negative equity in their home? Well, when we look nationwide here, we look pretty healthy. Most of the nation is at about maybe 1 or 2% of that small portion have negative equity. We've got a few states that are up here in the 5s and the 6s. What about Colorado? Well, we're sitting here with those borrowers that are in forbearance that have negative equity. It's about 1.2%. So again, this is a fraction of people that have negative equity in their homes. So if they do go the foreclosure route or they do end up selling, they're going to walk away, most of these people, with money in their pocket. Let's look at annual appreciation. This goes back 19 years. We're looking back to 1992 here. What does that historical appreciation look like? Federal government tracks it for the 3 largest areas in the Denver metro area. So that's Denver, Aurora, and Lakewood. We can see that our average annual appreciation for these areas is 6.9%. And we can see that we're pretty positive apart from these years in here where we're working through the inventory from the Great Recession. Especially looking back from 2012, we've had some really great appreciation. So we talked about mortgage rates impacting buyers and impacting those appreciation rates. And I think it's important when we talk about those increasing mortgage rates, what does that look like as we look back historically? So we know right now we're in the 5s for the 30-year fixed rate, 15-year fixed rate, just a little bit lower than that. This is, where we are right now. We've been pretty spoiled with having those rates below 4 and almost down to the 2s in some instances. But really, when we look back, it wasn't that long ago that we had 30-year rates, just even back in 2019, that were really going up and down, but really hovering near that 5% interest rate. And even as we look back a little bit further, we can see, rates were up in the 6s and even the 8s in the not too distant history. So we know with those mortgage rates that does impact our buyers. It doesn't mean that those buyers aren't going to qualify, but with those rising interest rates, that does impact their payment, right? And so something that might need to be adjusted for those buyers is what their price point of what the home they're purchasing is. We know at this point that, there's still going to be buyers that want to buy, and there's still sellers that have to sell or want to sell. We saw one thing that happened with COVID is a lot of people are moving to be towards family. They've prioritized that in their lives. We also have a lot of people that are moving maybe to their dream location because they can't. Their job is remote now, and so that frees them up to move and explore other parts of the country. So what can we expect going forward? Well, based on historical data, we're going to expect that we're going to have more homes come on the market as we head into later summer. July is historically a huge number for the number of homes that come on the market. And we also see our buyer pool decrease. People are on vacations. The interest rates are going to impact that, or they're just fatigued by trying to compete in this market. What does that mean for buyers? Well, that means more opportunity. Buyers aren't going to have to compete quite as much to buy those homes starting, as we head into the later parts of this year. And certainly might not have to bid as much over asking price or maybe anything over asking price. So there's definitely opportunities for these buyers as we look at that shifting market a little bit. Again, we'll have slowing appreciation. I don't think negative appreciation, but we will see that start to slow as we head into the year. We are going to remain in a strong seller's market. Even with these interest rates, we are short the number of homes that we need to have that would bring us into a balanced market. Based on the number of people that are already in Colorado that want to buy and the net migration to Colorado, we're short over 29,000 houses right now. That's what it would take to get us to a balanced market, which is 6 months of inventory. And where are we sitting right now? We have 1 week of active inventory. The last time we had a balanced market was in 2011. So we've been in this seller's market for a long time. And a thing to note here is that when we look at the residential building permits, builders are not going to build our way out of this. There's definitely new inventory that's coming online from those builders, but not enough to bring us to that balanced market area. So we talk about that average annual appreciation at 6.9% for those 3 biggest areas in the Denver metro. And not a financial advisor, but you might want to think about what is real estate, how is that performing as compared to your stock portfolio? So if you've got questions, please reach out to me. We know that real estate is not only local, but it's hyper local. So what's going on for you in your neighborhood is going to be a little bit different than just this overall look at the Denver metro area. Also, if you've got questions about wanting to use real estate to build your personal wealth or using real estate as a college investment strategy for your kids, please reach out to me anytime. I'm here to be a resource for you and answer your questions so that you can feel good about making those decisions. Thank you so much.